So it gives me great pleasure to open this second day of the Aon Insight series in Melbourne and hand over to the first session of the day, Keeping Pace with Climate Change. Here are Ben Miliauskas and Jeremy Barton.
Thanks, Lambros, and welcome everyone to today's session. What Jeremy and I will work through today is some of the facts and figures of a changing climate, and then some tips and tricks for taking on this challenging time. So let's start today by looking at some of the facts about the weather. These two charts show 100 years of average temperature. The top is for the globe and the bottom is specifically for Australia. Each bar represents the average temperature in that year. Blue represents below average. The darker the blue, the further from average. Red represents above average. And the darker the red, the more so. What becomes strikingly clear is the dominance of red on the right-hand side and blue on the left. Quite simply, the Earth is warming. And more specifically for us, Australia is no exception. Globally, we've not seen a below-average year since 1976. In the past 15 years, Australia has experienced 8 of its 10 warmest years on record. Furthermore, these trends are becoming stronger. What this graphic shows us is that the changing climate is driving a trend towards warmer weather. As we put more red bars on the right-hand side, the 100-year average goes up, creating this trend. So if climate change is a trend through time, what are the potential impacts on events that Australia is already used to experiencing? Based on work undertaken by BOM and CSIRO, we can confidently say that for Australia, mean temperatures will continue to rise. We just saw that. As a result, mean sea levels will also continue to rise. Extreme rainfall is likely to become more intense, but mean rainfall is likely to remain similar or slightly below current levels. Weather conducive to triggering and sustaining bushfires is likely to become more severe, with the length of bushfire seasons also increasing. Looking at this graphically really helps simplify this message. The curve here shows the probability of cold and hot days. Cold on the left, hot on the right. For the current or previous climate, on the left, shifting to the new climate on the right. As a result, there are a few features that we need to call out. We're expecting fewer colder days, shown in blue. We're expecting more hot days, shown in red. But also, we're expecting new hotter day extremes, shown in the dark red. So we're reaching new territory. So it is a changing pattern of weather. The distinction of the changing climate as a trend rather than events is quite important, especially when we think about insurance. Because in general, insurance is very good at protecting against events rather than trends. We like insuring storms, cyclones, bushfires. They start, they stop. They can be defined in time and space. Trends are a lot harder. When do they begin? When do they end? Where will they impact? More importantly, a changing climate doesn't cause loss. Heat does, rain does, wind does. So the proximate cause is very hard to define. For this reason, it's very difficult to simply insure climate change. Instead, we need to insure the antecedent events. Rather, let's look at the perils that are going to be impacted by this changing trend. This is where we start to move into some more speculative aspects of the discussion, and hence they're pretty hotly debated. Excuse the pun. So what are the potential impacts? Droughts. If we're expecting hotter weather, we should be expecting more drought activity. Heat waves, already the single biggest killer in Australia. In 2009, the Black Saturday bushfires followed 2 heatwave events across South Australia and Victoria. Tragically, 173 people died from the bushfires. A very, very sad event. At least 430 people died from the heatwave events that preceded them. A stark example of the impact of heat waves. We'll delve into bushfire in a minute and talk a little bit about 2019 and 2020. When we think about flooding from extreme rains, we're also seeing larger sea level induce storm surges during low pressure systems. They're extremely destructive hydrological events. Coastal destruction. We're already seeing a lot of destruction on the coastal edges of Sydney's northern beaches. This is well documented. And this week we even saw more damage from landslides in these areas as well. And what happens with our energy demands if hot summers become more extreme? Will we see more scheduled blackouts and brownouts? What are the implications for business interruption and supply chain disruption if these types of events take place? I suggested we'd revisit bushfires in a minute, and here we are. So this is a very busy slide. It details some of the statistics and outcomes of the 2019-2020 bushfires. I'm not going to talk to all of these points, but it's a great reference and some interesting reading for those who have time. But a few statistics I find quite fascinating about these events. Air pollution reached levels 11 times worse than considered hazardous during these bushfire events. 8.6 million sheep and 2.3 million cattle were lost. Today, sheep are selling for about $300 a head, which means that this loss was around $3 billion in sheep alone. The amount of carbon released was equivalent to about 70% of Australia's annual man-made budget. That's a staggering amount to pack into one event. Again, I'm not suggesting we did not have bushfires in the past and that this is all a result of climate change, a long way from it. Rather, what are the potential implications of these types of events becoming more common? What if 2019 or 2020 became a 1 in 10 year event rather than 1 in 100 year event? How do we optimize our businesses, the economy, society in general, to have a year like last year on a more frequent basis rather than having it as a rare exception? Transition risk is a key factor in the discussion. It's important to embrace the various opinions on this issue, and platforms such as this invite people and organisations to come together and have a sensible, well-rounded debate on this topic. As you may have noticed, some high-profile individuals and organisations are starting to be more vocal in their stance and strategy, and in some cases, are setting some aggressive goals and targets. By way of example, Larry Fink, CEO of BlackRock, the world's largest asset manager, has put companies on notice that they will find access to capital more expensive if they do not decarbonise. Eventually, they may not get capital at all. Very big statements, very big statements. Transition risk is an important factor in getting carbon neutral. A key aspect in any transition is to take a measured and nuanced approach, sensitive to minimising social and economic disruption. The more time we take to manage any transition activities, the more likely it will be that we'll have a smooth outcome with minimal disruption. The AL Global Risk Management Survey for 2019 polled 2,600 risk professionals in 60 countries to identify what they considered the key threats. When we look at the results, it's fascinating to think about how many of the risks are influenced by climate change. I mentioned the impact on number 30, asset value volatility before, a really simple example. Number 21, property damage. Again, some pretty obvious impacts when we think of damage to assets. Number 9, failure to innovate and meet customer needs. What do environmentally customers expect in the future? A recent survey found that about 89% of Gen Xers would rather buy from a company supporting social and environmental issues over one that does not. A personal favourite of mine is number 11, failure to attract and retain talent. 64% of millennials consider a company's social and environmental commitments when deciding where to work. 83% would be more loyal to a company that helps them contribute to social and environmental issues. These aren't small numbers. I'd argue that at 83%, the vast majority of your talent pool is interested in this topic. Fascinating to think about when we consider attracting talent in the future. Beyond the specifics, however, my point is that when we think about the impacts of climate change, the implications are wide and probably not well thought through in many organisations. If we consider the risks that keep us awake at night, they're probably going to be amplified going forward, retarding our ability to predict the outcomes and driving greater uncertainty. So let's hear from Jeremy now about some considerations on how we move forward through this state of flux.
Thanks, Ben, and good morning, everybody. I'm really excited to be with you today to walk you through 5 themes that I believe every risk manager and every organisation should have in the front of their minds when thinking about climate change. And these are regardless of where you are in your climate change journey or even what industry or geography you're in. So, the first of my 5 is that action is needed now. And I think a lot of organisations are starting to act. In fact, in the last 6 months, Aon has seen more inquiries than ever before from clients around climate change risk. And as we know, this is during a time where COVID-19 has provided a very stubborn and very significant distraction. And I think this interest is for a number of reasons. As Ben has shown, facts around climate change are indisputable. Temperature has already risen by 1 degree Celsius, and it looks ever more unlikely that we'll be able to restrict temperature rise to less than the 1.5 degrees target. Also, the rate of change isn't linear. It might be accelerating, and it's certainly unpredictable. This combination of unpredictability and uncertainty means that there will need to be changes in business strategy. For some, this might be around how you protect or place your physical assets. But for others, it might be a fundamental change of how you consume resources or how you need to apply your resources to new emerging areas of the economy. And ultimately, this takes time, this takes effort, so preparation needs to start now. Additionally, the capital markets and regulators are starting to move very fast. The prudential regulators in Europe, Japan, as well as Australia, are well advanced and progressed around this topic. They're obviously focused and foremost interested in the integrity of the financial markets. And therefore, next year we will see banks and insurance companies going through financial stress testing in relation to climate risk. This means capital providers and investors will become more and more interested in climate risk too. And certainly within the insurance sector, they're becoming a catalyst for change. My second point is that data and analytics are critical for decision making around climate risk. Ben gave you a view of how Aon's thinking about data and analytics for climate change. And Aon's making some fantastic investments around the globe, both internally in proprietary techniques, but also with partners that we're working with, who have bespoke and different skills that are required in order for us to be as fully informed as possible on this topic. However, you might be pleased to know that I'm not going to talk in detail about specific models or techniques. Instead, I'm going to channel the spirit of my dear grandmother, who seemed to have an adage, a saying for every occasion. And I have 3 for you about climate change. The first is, you can't manage what you can't measure. And by this I mean, you must take a robust data and analytics approach to your climate change planning and decision making. You need to leverage all available data to become fully informed. In fact, many regulators and international frameworks have data as a key component. The second adage is, all models are wrong, but some are useful. It really is a case of treading carefully and understanding what is informing a particular model or a particular tool. You need to understand the assumptions that underlie it. And that leads me to my final saying, and it's an apt one with next week's Melbourne Cup on the horizon. There are horses for courses. There are different tools for different jobs. And the example we have here on the screen is a really good one. CAT models are fantastic snapshots of current risk and to inform short-term decision making. However, climate models, on the other hand, are about illustrating potential visions of the future and are much more appropriate for longer-term strategic decision making. Different tools cover different risks, and it's important that you take away that whilst data and analytics is essential, before you embark on your data analytics journey, do as much thinking as you can about your climate change risk needs. By this, I mean think about what your organisation, your colleagues, and even your customers' investors think about climate change. Work through what risks and opportunities you face and build out hypotheses around them. And then align your data analytics needs to these hypotheses. Insights from data and analytics allow for flexible decision making. And flexibility is inherent within climate change thinking. In fact, international frameworks prompt flexibility in the way organisations are thinking about climate change. They actively encourage people to think about more remote and obscure risks that organisations might face, as well as the ones arising from conventional scenarios. Organisations also need to be flexible in their decision making. You'll need to be willing to change your mind as new risks emerge or new data becomes available. And for all the risk managers in this room, or the virtual room as we most often are in these days, you'll need to be flexible too. You're likely to be responsible or involved in quite a holistic set of decisions related to climate change risks, of which insurance buying is actually only one. The picture I have on screen is a good example of flexibility when it comes to climate change risk. It's a proposed flood defence system in Manhattan. And the risk managers and others involved in the project were not only thinking about the way they could mitigate the risk from flooding in the area, they were also thinking about the way they could protect the longevity and affordability of their insurance coverage. Climate change is a financial risk. The TCFD framework shows that organisations need to treat climate change as a financial risk. It's not just about insurance or reputation or even social responsibility anymore. It impacts all areas of the financial state. Organisations need to have a clear plan on how they will monitor and manage financial risks from climate change, in line with their risk appetite. You need to incorporate the financial risks from climate change into existing financial risk management practices and identify, measure, monitor, manage and report on these risks. You also need to keep reviewing as your understanding of the financial risks from climate change will be ever evolving as you get more granular in your understanding of your business and the way that your business will be impacted both negatively and positively from climate change. Following on from financial risk, we need to understand that access to capital is also highly competitive. And I like to think of capital not just in terms of investment and financing, but also insurance capital for risk transfer. And whilst capital likes risk, and insurance capital likes risk, it likes the right type of risk. And the thinking is that when it comes to climate risk, insurance capital is going to value maturity. There is no perfect risk to price index, and risk is always subjective, and climate change risk is going to be the same. However, that makes it really important to develop a climate risk story for your organisation. And that's what we have on this slide. On the left-hand side, it's starting to bring together the different pieces of climate thinking within your organisation, bringing them together into a coherent strategy. And on the right-hand side, translating that into risk management action, so you can articulate to all of your stakeholders, including capital providers, what you think, what you believe, and what you're doing about climate change. This will allow you to have conversations and engagement with stakeholders and capital providers in a much more productive way on this ever important topic. However, please don't go away from this believing that it's all doom and gloom. As always, when there are risks, there are also opportunities. And this slide sets out some of the areas that organisations can start to explore. I'm going to ask Ben to come back off mute and share with the audience where he sees some of the opportunities developing over the coming years.
Thanks, Jeremy. Yeah, really exciting slide in my mind because this really is a space that, if tackled correctly, creates some great opportunities for organisations. In the most simplistic form, I'd be suggesting that any CapEx decisions or due diligence type activity should be taking into account climate change and the changing nature of perils in Australia. We've got data sets that look at climate change impacts down at a street address level for every address point in Australia. So it's very easy for organisations to look at, if you're about to make an investment, the risk that investment could be under both now and at 2 timestamps in the future for every peril in Australia, whether it be flood, bushfire, wind, hail. Really simple activities that organisations can put into play now to make sure that in the future they're actually in their own most robust state possible. And as you say, be the most attractive assets for insurers to be supporting. Probably the greatest opportunity in my mind, though, is around corporate resilience. My personal interpretation of resilience is the ability to thrive during disruption rather than just survive. This is moving from a mindset that simply struggles through to one that actually uses disruption to better an organisation and improve your position. By way of an example, when an event takes place, how do I service my competitors' customers when my competitor can't? How do I use this turmoil to actually catapult my organisation? In a changing climate, if we expect more volatility, how do we plan for that now? Simple examples in supply chain risk, for example, are easy to get our heads around. So for a logistics organisation, how do I ensure that I have no key site dependencies? How do I have multiple access routes? COVID's also shown some vulnerabilities born over dependencies in suppliers. So how are my suppliers vulnerable to climate change? Do I have multiple sources for the inputs that I need? Interestingly enough, there's some research has shown that 1 metre of sea level rise would inundate about 405,000 hectares in Indonesia. So suppliers in Indonesia, and I'm selecting Indonesia as one example, I'm sure there's many, but depending on the supply chains coming from Indonesia, that could cause some great vulnerabilities depending upon how dependent you are on these supply chains. So truly resilient organisations have these types of scenarios built into their planning. They've got strategies to handle these sorts of disruptions and make sure that they can grow after an event rather than just suffer through. Jeremy, what topics on this slide do you think are of particular pertinence to yourself?
Yeah, thanks, Ben. Obviously, I think the resilience one is a really interesting one, but with my consulting and customer experience background, I'm going to pick on changing customer demands. And it's a really interesting area, which I think also ties a little bit into improved reputation. I remember reading a few years ago that Nielsen did some research that found, a large proportion of millennials were willing to pay more for sustainable goods. And this year, Forbes did a similar article where they found 62% of Gen Z, who will actually be entering the workforce this year, prefer to buy sustainable brands, which in fact was on par with the millennials as well. Further, the Generation Z stated that they were willing to spend an incremental 10% or more on sustainable products, which was about in line, 50% of millennials saying the same. You've got over half these two generations really focused on climate change and resilience and climate and sustainability. And I think you only needed to look at the news last year around the climate protests that the younger generations are interested, and it's a growing movement. However, for me, the really interesting thing is if you compare this to Generation X, which 34% said they were willing to pay more, and the baby boomers, where only 23% said they would pay more. it appears that with every generation, this quest for sustainability strengthens. And as we see that transfer of wealth over the coming years and the preference of Gen Z and millennials sort of coming to the forefront in the way that we need to treat our customers, climate risk will become, or climate change will become, an ever more important topic for any organisation. And I really think that organisations who ignore it, it will be at their peril. So with that, I'm going to pass back to Jason.
Great, thank you, Jeremy, and thank you, Ben, for that fantastic overview of keeping pace with climate change, which was really, really insightful. We have received a range of different questions coming in from the audience, guys, and we've got some time to go through this. So I'm going to go through these quite rapidly, and there's some great questions that we've got that coming. But the first one really links, and I'll pass this one to you, Ben, is what can companies do to get started on addressing climate change if they haven't already? Where do they start? What are the first things they do, Ben? What would you recommend? Over to you, Ben. Jeremy, are you still on the line? I think we may have lost Ben.
I think we've lost Ben, so I'll have a go at it as well. I think, really it's about starting to get collective thinking across your organisation. And, I think climate change means a lot of different things to a lot of different people. I'm sure everybody has a view of climate change within your organisation, but it's a bit like if you told everybody to think of a fruit. Somebody would think of an apple, somebody would think of an orange, and somebody would think of a pineapple. So getting that sort of collective thinking so you've got a single vision is really important. We've actually been running workshops for a lot of clients to help accelerate that. And once you've got that section, that's when you can start to look at what are your risks and your opportunities around it. But until you've got that single vision, it's very hard to move forward.
And I know you're back on now and the sound is good. Have you got anything else to add to that first question around how companies can get started on addressing climate change if they haven't already?
Yeah, sure. No, Jason, I think it's a really good question. And to pick up on Jeremy's habit, an old adage comes to mind with this one of you eat an elephant one bite at a time. We see a lot of organisations actually found themselves in a state of stasis where the problem looks so big they don't even know where to start. And in my mind, if you think about the smallest step that you could begin with, then it will get you on the journey and momentum will build, and organisations become more and more adept at taking climate change into consideration in their decision making. And again, really simple tasks such as just listening to your insurers, talking to your Aon partners. These are ways of actually just starting the conversation young in an organisation, and you'll easily get some insights because a lot of people like to talk about this topic.
Yeah, thanks, Ben. Ben, I know you've been with Aon for a number of years, and a lot of us know you as a cat modeller. That's really where your background is. You've really been one of our subject matter experts on cat modelling catastrophes. I really like Jeremy's contrast between the difference of cat modelling versus climate change modelling. Ben, have you seen Aon's capabilities expand specifically in that climate change area? And if so, what sort of examples can you give us? Are you doing specific projects just on climate change?
Oh, great question, Jason. Yeah, so as Jeremy said, climate models look at long-term predictions over many, many decades. Catastrophe models look at a snapshot of expectations for next year. And what we're trying to do is actually couple these models together to say, well, what do we think a cat model would look like, take into account weather patterns in 20, 30 years' time and the changing landscape. And so we can use these tools to give some great insights about where we think risk is changing, the impact of that risk, as I say, down to a street address level for many organisations. When we see this put into play, there's organisations such as the Australian government, when we start looking at, say, flood schemes or potential solutions for the northern Queensland, trying to employ some of this logic to predict what we think the expected loss activity would be in decades' time in some of these areas to create sustainable insurance solutions and sustainable insurance markets to support these communities. because I think it is crucial to recognise that these tools are being used to try and make sure that we can future-proof the economic benefit of the insurance system.
Yeah, absolutely. No, thank you, Ben. And Jeremy, a question for you. This one's on data and analytics. I know this is a theme close to your heart, but what role can data and analytics play in helping organisations to understand climate change?
Well, I'm going to say it's the most important role. Ultimately, it will drive all of your decisions, but it only works if you understand what your risks and opportunities are. So do that bit of work first and then work out which of the models, which of the data aligns to it. There is so much out there that you need to be making sure you're using the right model and the right techniques to look at the right risks that you have. And that's where people like Ben are great, or even some of your other risk advisors at Aon can come in and help you just really identify what's the best horse for the course, as I said in my presentation.
Yeah, great. Thanks for that, Jeremy. And Ben, just another question for you, more around capacity, insurance capacity. If we have a look at the market conditions we're experiencing at the moment, which people would say is really starting to become constrained, do you think insurance capacity is going to disappear for certain industries?
Yeah, it's a great question, and it's always such a volatile market in some respects, isn't it? But the insurance industry has always adapted to changes in the economy and changes in our understanding of risk. Most insurance carriers want to be reliable long-term partners with their insureds, and quite frankly, insurance companies make money by writing risk. If they avoid risk, they're not actually turning over the income that they need. This is what they do. A carrier who can clearly explain their position on climate change, the internal and external drivers that influence their decisions, and how they want to work going forward is likely to be there for you and the industry going forward. Remember, the underlying risk, however, is the basis upon which carriers make their decisions. And so the more you can work with your carriers to inform them around what your risk looks like, on one hand, they'll have a lot of the data and science around how that risk is going to be impacted by the events. But it's in that clarity around the data of your organisation that really makes risks insurable and makes sure that insurance capacity will be able to maintain its support long term.
Yep. Yeah, and when, Ben, just following on from that, when do you think capacity will reduce? Are we starting to see that now in some risk categories?
Yeah, I think we are starting to see it reduce in some categories. But again, the amount of capacity that's available in the market is not shrinking. A lot of research done by Aon actually illustrates that there is plentiful capacity in the market, and there's plentiful capacity to access. It's a case of where that capacity wants to be deployed. And changing frequencies, changing severities don't necessarily scare insurers so long as the pricing can be appropriate to actually underwrite that risk. And really where that boundary hits is where actuarial perspectives on a particular return period from an event really become excessive to a point where it really hits the limits of insurability from a dollar swapping perspective. And so this is where mitigation strategies might come into play. I'd definitely suggest talking to your carriers around what sort of investments could be made on an asset that's in duress for placement to try and make the asset more insurable. And there's some great engineering solutions being thought about in this regard. I think Jeremy's example from Manhattan was a great one that illustrated how the public sector and the private sector were trying to work together to make sure that long-term assets in that area were insurable going forward in a changing climate environment.
Yeah, great feedback. Thanks, Ben. And the other area I wanted to explore today's discussion is really about this capacity crunch, this capacity issue. What do you think direct clients will do, as opposed to insurance companies that I know you and Jeremy deal with? What do you think direct clients are going to do when this capacity starts to dry up? Any views on that?
Yeah, sure. Good question. So I don't think most clients will face complete withdrawal of capacity, but the world is a dynamic and volatile place. Firstly, again, it's engaging with your carriers, see what investments can be made. If you happen to be impacted by changes in capacity, you've got options through alternative capital, such as the ILS market, and through captives. It's critical to have an in-depth understanding of the risks that you're looking to cover to ensure that you're attractive to investors and reinsurers and insurers. They might even offer additional protection depending on the investments that are being made. Finally, parametric solutions are also an interesting alternative. I'm pretty passionate about parametric solutions. What makes them more sustainable in this discussion is that we've got lots of data that can be forecast to look at how the triggering of the cover may work. And when I say a parametric solution, just to backtrack a little, we're talking about, say, an insurance that pays based on the amount of rain that falls rather than indemnify the dollar loss.
Yep.
And so if we're using rainfall data, we've got centuries of data to use to underwrite. We can forecast that data based on weather trends that are coming up, which means that, again, insurers are not surprised by the risk that they're facing and really it's that surprise that impacts the ability to access capital.
Got it, Ben. No, that's really helpful. Just on the parametrics comment, there's a case study that we're featuring at this Aon Insight Series event with one of our US clients called Comcast. And for their property program, you'll be interested to know that they carved out some specific Nat Cat exposures from their traditional property insurance, and they now actually purchase parametric cover on those exposures. Is that a trend, Ben, that you're starting to see with corporate clients in this part of the world, or is it too early yet? What are some of the signs you're seeing?
Yeah, the really, really strong trend we're seeing here, Jason, that where underwriters are finding particularly troublesome risk, whether it's, say, be bushfire in forested areas or cyclone risk up north, where that is becoming an impediment to placement going forward, we're carving these exposures and risks out and placing parametric solutions to purchase standalone products. At the moment, the cost of these products, the insurance costs have not increased to a point where it's actually crossed over a lot with the parametric margins that are being charged. But we're getting closer and closer to that point as the market has been seen to contract. And it's an interesting conversation always to walk into an insurer and say, well, listen, we've taken away the biggest risk that's concerning you. So
yes,
now we're
absolutely.
going to premiums. Really, really powerful stuff to see. And I personally think that as society gets more engineered, as our knowledge of our assets gets more engineered, we can actually use parametric solutions that are much more closely aligned to those expectations and performance predictions of our asset base, which actually means that we're not paying full cover that we don't need. If I build a large asset that I know will withstand a cyclone coming through, and it should last up to a Category 4 cyclone, I don't need coverage below Category 4. So we're actually leveraging that investment in our upfront mitigation and construction into saving money on our premiums at the back end that we don't need to spend.
Yeah, good feedback. Thanks, Ben. And Jeremy, question for you that's come in. This question around insurance companies and banks starting to hold capital against climate change risk. Are you seeing much interest from insurers to really understand that quickly now as regulators change their viewpoint? And what sort of work's being done in that area?
Yeah, so the TCFD, so Task Force on Climate-Related Financial Disclosure, which is a little bit of a mouthful, but abbreviated, is really driving a lot of this change. And you're already seeing the major insurers leading the way, I would say, to a certain extent in Australia. Europe is very advanced, in Japan as well. I would say that we'd be even more advanced if it wasn't for COVID. But this will become law, and this will become, actual financial disclosure, which has to go on, and therefore, that will be a catalyst of true disclosure from all of these companies. So, I think, if you go and have a search, there's some of the large insurers in Australia have some great, WebExes or webinars out there on what they're doing already. So I'd encourage people to go and do a bit of a Google search and watch some of those videos because they're actually really insightful.
And Jeremy, when do you think this focus on allocating capital for climate change risk, when do you think the shift may start to move from banks and insurance companies to perhaps non-banks, non-insurers, just typical industry-based businesses that are going to have to start thinking about holding capital against climate change. Is that years away, or do you think that's closer than what we might expect?
Yeah, look, I think maybe the holding capital is a little bit further away for some of the industries, but what I do think will be the catalyst of disclosure on climate change risk will be really the investors who will be pushing for it. I think we've already seen this trend of investors looking at climate change, given the banks and insurers from a capital perspective, and that will just flow through. Once again, if you look at some of the large superannuation funds in Australia, they're already making views on the allocation that they're going to put against climate sustainable investments going forward. So it's not far away. And plus, I think if you're not doing it, you're going to be the odd one out, and people are going to probably start to ask why.
Yeah, absolutely, Jeremy. That's great. And ESG is obviously a totally different topic that we're not going to dive into huge amounts of detail in today's session, but I think it's one that we're probably going to have to cover on next year's Insight series in particular. But some fascinating insights there. Ben, I've received another question around what are insurance companies doing if their capital now is less efficient or going to be less utilised by some of our clients who may seek parametric solutions. Where are those solutions coming from? Are they coming from other insurance or reinsurance capital? Are they coming from capital markets? Are they coming from hedge funds? Just explain some of the dynamics there and what you see playing out.
Yeah, really interesting question. So probably a decade ago, these parametric solutions were being underwritten by non-insurers and by hedge funds and alternative capital providers. Increasingly, we're seeing the insurers and reinsurers move into this space. So now we've got about 20 markets that we trade with. We can trade insurance, reinsurance, or securitized deals in parametric weather. And so more and more, we're actually seeing the insurers recognize the migration of the risk into this space. Interestingly, I'd say some of the insurers are probably more interested in supporting these types of products going forward than some of the indemnity-based products in risks such as bushfire, where again they can get a measured approach. It's a lot less dependent upon individual organisations' mitigation strategies. It's a more independent way of actually underwriting the risk. The other advantage is that from a claim settlement perspective, it's a much more efficient approach. We saw the Black Saturday bushfires as a class action that went for close to a decade that impacted the liability insurance space, the casualty space in Australia. And so it took a decade to settle that claim, whereas a parametric claim is settled 3 months after the data's collected by the BOM. That's when audited data comes out. So it's a much more efficient approach in some asset classes where, say, it's very hard, or some risks where it's very hard to understand all the assets. If they've got complex asset schedules, you can get around that.
Fantastic. Thanks, Ben. So I think most importantly, as the insurance market changes and a lot of our direct corporate clients start to deal with hardening insurance capacity, some of these parametric solutions are very relevant. And most importantly, we've heard from two subject matter experts here that can provide guidance and assistance. I know, Ben, you've spent a lot of time advising insurance companies on some of these solutions, but I know a lot of your time now is focused on advising corporate clients as well. So obviously you're available to take any further questions or inquiries separate to this session. So
no, certainly, Jason.
Fantastic. So Jeremy and Ben, most importantly, thanks so much for taking us through this session around keeping pace with climate change. A very topical issue, one that's directly impacting the Australian economy and environment and the businesses that are obviously at our event today. And most importantly, we'll come back and readdress climate change moving forward at subsequent events.